While the retail crowd is still chasing Nvidia's daily moves, institutional allocators are quietly positioning for a massive rotation. The explosive artificial intelligence rally has reached a critical bottleneck. It is no longer just about raw computing power. The real battleground has shifted to memory bandwidth. This structural shift is putting a few specialized memory manufacturers in a position to deliver massive surprises. The market might be completely underestimating how fast their margins are expanding right now. To understand why this matters, we have to look at the global memory landscape. For years, companies like Micron Technology and Samsung operated in a highly cyclical commodity market. But high-bandwidth memory, or HBM, changed the game. This is not your standard PC memory. HBM stacks dynamic random access memory vertically, placing it directly next to the GPU. This architecture creates a massive physical moat that requires extreme engineering precision. This design dramatically increases data transfer speeds while lowering power consumption. For artificial intelligence clusters, that speed is everything. Without advanced memory, even the fastest Nvidia chips sit idle, waiting for data. This reality elevates memory from a cheap commodity to a premium, non-substitutable asset. Micron and its peers now hold incredible pricing power over the entire hardware stack. That's where things get interesting for investors. Let's look at the financial proof. The recent quarterly numbers from major memory players show a spectacular reversal of fortunes. We are seeing triple-digit growth in specialized data center revenue. This sudden surge is driven entirely by the insatiable demand for high-bandwidth memory. Instead of the typical slow recovery, these firms are experiencing an unprecedented demand shock. The revenue mix is shifting rapidly toward these high-margin, premium products. Here is where the margin metrics become interesting. Gross margins are expanding at an accelerating rate, blowing past previous Wall Street consensus. Memory makers are successfully passing high production costs directly to buyers. Because supply is so tight, customers are signing long-term volume commitments. This provides these companies with rare earnings visibility that we have not seen in previous market cycles. Management teams are reinforcing this structural shift. Executives at Micron recently confirmed that their entire production capacity for high-bandwidth memory is fully sold out. This supply lockout extends not just through this year, but through the end of next year. They are already pricing contracts for future capacity at significant premiums. This suggests the traditional boom and bust cycle has been fundamentally disrupted by AI demand. The next signal comes from management's capital allocation. Instead of blindly building massive new factories, these companies are taking a highly disciplined approach. Capital expenditures are focused strictly on upgrading existing lines to high-bandwidth memory. They are prioritizing near-term margin expansion over market share wars. This disciplined capital allocation is a massive win for shareholders who want capital returns rather than reckless dilution. Now look at how the broader sector is reacting. The macro environment is highly supportive of hardware infrastructure. Hyperscalers like Microsoft, Google, and Meta are continuing to increase their capital budgets. But there is a massive competitive bottleneck. Only 3 major players globally can produce these high-end memory chips. This triopoly ensures that pricing power remains firmly in the hands of the manufacturers. This is exactly why memory could outperform Nvidia in the next phase. Nvidia's valuations are incredibly extended, leaving very little room for error. Meanwhile, memory stocks are trading at much lower multiples despite experiencing a similar demand acceleration. As Nvidia's chip deliveries face physical supply limits, the relative value of memory chips is rising. We are looking at a classic sector rotation play. But that is only part of the story. We must address the real risks. Producing high-bandwidth memory is incredibly complex and capital-intensive. Low manufacturing yields could quickly erode expected profits. If a company struggles to scale production, it faces severe financial penalties. Additionally, raw material costs and specialized equipment prices are rising, which could squeeze margins if demand suddenly cools down. That leads us to a bigger question regarding systemic risks. Global trade tensions present a major threat. Many of these memory fabs are located in geopolitically sensitive regions. Export controls could block shipments to key Asian markets, instantly disrupting revenue. Additionally, if the broader enterprise market slows down, standard consumer PC memory pricing could collapse, hurting overall corporate earnings. Despite these risks, the forward outlook remains compelling. From a valuation perspective, memory stocks offer an attractive risk-to-reward ratio. As earnings estimates are revised upward, forward price-to-earnings multiples are actually contracting. This creates a rare setup where a stock can rise while technically becoming cheaper relative to its earnings power. This is the definition of structural momentum. This multi-year thesis relies on the next generation of AI systems. The transition to advanced liquid-cooled servers will require even denser memory configurations. As standard servers get upgraded, the demand for high-capacity enterprise drives will soar. This ensures that the memory industry's growth runway extends far beyond the current hardware hype. We are watching a fundamental repricing of a critical tech subsector. Here is our tactical review. We are placing key memory producers on a strict breakout watch. We want to see sustained volume-backed momentum as they clear major overhead resistance levels. Conversely, certain hyperextended chip design firms are entering a trim consideration zone. When valuations become this detached from near-term cash flows, trimming some gains to fund capital rotation into cheaper memory assets makes structural sense. As institutional capital quietly repositions, keeping ahead of these subtle shifts is what separates retail traders from serious investors. If you want to navigate this evolving market with high-grade institutional intelligence, subscribe to SR Money News right now. Join our community of sophisticated investors who prioritize deep fundamental analysis over daily noise. Turn on notifications and share your thoughts on memory versus GPUs in the comments.